Welcome back to The Explainer. Today, we're doing a deep dive into two of the absolute biggest forces in the global economy, Walmart and Amazon. But, we aren't actually looking at what they're selling to consumers today. Instead, we're looking at what the titans behind them are doing with their money right now. We are evaluating two mega-cap giants moving literal billions of dollars in completely opposite directions. And to make sense of it all, we're going to use some classic valuation models to figure out exactly what's going on behind the scenes.
So here is the multi-billion-dollar question we are answering today. On one hand, we have the heirs to the massive Walmart retail empire methodically selling off huge chunks of their stock. And then on the exact opposite end of the spectrum, we've got Amazon, this absolute tech and retail behemoth, just opening up its wallet and spending money at a rate that is honestly making some investors sweat. It's an incredibly fascinating contrast in capital allocation.
Just to give you a real sense of the scale we're talking about here, $23.3 billion. That is the combined wealth drop of Alice, Rob, and Jim Walton since the beginning of the year. Now, a lot of this is just tied to the natural, everyday fluctuations in Walmart's share price. But it also directly coincides with their continued, very deliberate reduction of their holdings in the company that their father founded.
Okay, now contrast that staggering wealth drop with a very different but equally massive figure, $200 billion. That is the amount of capital expenditure Amazon is planning to deploy over the coming years, specifically for artificial intelligence infrastructure. So while the Waltons are pulling their money off the table, Amazon is basically pushing an unprecedented amount of chips directly into the center of it. Section 1. Why are the Waltons selling? Methodical divestment.
Okay, let's dive into this, because this table brilliantly illustrates how the family's selling is actually super methodical. It's not panicked at all, it's completely driven by market context. From 2015 to 2018, they sold $2.1 billion during a period of massive e-commerce disruption just to rebalance their portfolio. During the wild pandemic volatility from 2020 to 2022, they sold $3.7 billion to reduce risk. And from 2023 to the present day, they sold another $1.9 billion amid broader economic uncertainty. So as you can see, this absolutely isn't a fire sale, it's a highly strategic adjustment.
And the secret behind this methodical approach is something called a 10b5-1 plan. Basically, these are programmed automated selling arrangements that are set up well in advance. The Waltons set the parameters, and then the trades just happen automatically. It completely removes human emotion from the equation. It's concrete proof that they are strategically managing their generational wealth, rather than just reacting to whatever the stock market decides to do on any given Tuesday.
So if they aren't panicking about Walmart, where exactly are those billions going? Well, they're diversifying. They've already poured an estimated $1.2 billion into private equity for healthcare tech. They're heavily buying into sustainable infrastructure and renewable energy. They're acquiring agricultural land in water-rich regions. And, of course, they're funding their family foundation's educational and philanthropic initiatives. Essentially, they're taking highly concentrated retail wealth and spreading it across entirely different future-facing asset classes.
And this right here perfectly proves why following insiders selling blindly can be a massive mistake. Look at the third quarter of 2022. The family sold off $740 million in stock, which temporarily spooked the market and caused a quick 7% price drop. But if you understood this was just program diversification and not some fundamental problem with Walmart's business, you would have captured a 23% return over the next 6 months as the company completely crushed expectations.
Section 2. Amazon's massive AI bet, funding the future.
Now, what's really interesting about this slide is that to truly understand Amazon right now, you have to look at the sheer cliff dive drop in their cash flow. Last year, Amazon's trailing 12-month free cash flow was a massive $25.9 billion. This year, it shrank to just $1.2 billion. On the surface, that is a terrifying drop for casual investors. But let me tell you, that money didn't just vanish into thin air. It was aggressively deployed.
That vanishing cash is exactly what's funding that $200 billion AI bet we mentioned earlier. They are aggressively building out massive data centers and top-tier networking equipment. They're developing their own custom AI chips, specifically the Trainium and Graviton. And they are signing these huge multi-gigawatt infrastructure deals with leading AI startups like OpenAI and Anthropic. They are literally brick by brick and server by server building the physical backbone of the artificial intelligence revolution.
But the ultimate justification for all of that jaw-dropping spending is this number, $364 billion. That
That is Amazon Web Services' current backlog. In simple terms, this is revenue that customers have already contracted and legally committed to paying Amazon for cloud and AI services, but that Amazon just hasn't officially reported on their income statement yet. It is a massive, built-in financial safety net sitting right there in the wings, just waiting to be realized.
Section 3. The math behind the moves. Value investor tactics.
To really look under the hood here and cut through all the headline noise, we need to think like legendary value investors. Think Warren Buffett, Peter Lynch, or Benjamin Graham. Now, while a dividend discount model, or DDM, might be the perfect tool to value a mature dividend-paying company like Walmart, for an absolute growth machine like Amazon, we need to use the discounted cash flow, or DCF model. A DCF basically projects the massive cash that Amazon's AI investments are going to generate over the next decade, and then discounts that back to figure out what the company is intrinsically worth today.
And guys, when you actually run those projections, the results are pretty staggering. While Amazon's current share price has been hovering around $245, a two-stage free cash flow to equity model puts Amazon's estimated intrinsic value at roughly $475 per share. That means the stock is screening as over 46% undervalued right now. The broader market is essentially punishing them for their heavy capital expenses today, while the fundamental math strongly rewards them for the massive cash flows expected tomorrow.
We actually see the exact same story play out if we look at the price-to-earnings, or PE ratio. Currently, Amazon trades at about 30.2 times earnings, but when you factor in its sheer, unbelievable size, its operating margins, and that massive AI growth profile we just talked about, financial models suggest a fair PE ratio would actually be closer to 44.4. So even on a basic earnings multiple basis, the stock appears fundamentally undervalued compared to what informed, value-driven investors would typically be willing to pay for this caliber of growth.
The overarching bull case narrative for Amazon right now really comes down to this single powerful revelation. Amazon is sacrificing short-term margins to secure long-duration dominance in AI infrastructure, advertising, and automated commerce. It is a classic textbook delayed gratification play. They are happily, deliberately taking a hit to their current free cash flow to ensure they absolutely own the critical tech infrastructure of the future.
Section 4. Reading the market signals. Ignore emotional noise.
So, the crucial point is, what are our core takeaways from all this? First, as the Waltons just brilliantly showed us, insider selling often just means strategic diversification, not panic about the underlying business. Second, massive capital expenditure isn't always waste. Very often, it's the required price of future dominance. Third, short-term cash burn can easily mask a company's true long-term intrinsic value. And finally, relying on fundamental valuation models, like the DCF, helps us see the actual math behind all the market noise.
And Amazon CEO Andy Jassy recently addressed the Wall Street anxiety around their massive spending with this amazingly simple, direct quote regarding their AI investments. He just said, "We have high confidence this will be monetized well." It's a bold statement that directly asks investors to trust the long-term vision over a snapshot of the short-term balance sheet.
And honestly, that brings us right to our final thought for today. We've seen the Waltons methodically secure their generational wealth, and we've seen the underlying math that suggests Amazon's multi-billion-dollar spending spree might be deeply undervalued by the current market. So the question I leave you with is this: when you look at these titans making their moves, do you trust the fundamental long-term cash flow models, or do you get swayed by the short-term market reactions? Thanks so much for learning with me today. Keep analyzing, keep looking under the hood, and I'll see you in the next explainer.